Hello and welcome to Course 1, Unit 2, Lesson 1, What is a Bond? In this lesson, we're going to learn about what a bond is, who uses bonds, the bond risks, and why is bond investing so lucrative. So let's get started. The first thing to understand about a bond is that it's nothing more than a loan. So as I describe the following scenario, just keep that in mind as we go throughout this lesson. Okay, so let's start off with a representative from a large business that we'll call the business Real Estate Empires. This is the CFO and his name is Jack. And as the Chief Financial Officer, Jack is responsible for making sure that any type of financing that goes through the business all runs through Jack. So Jack's responsible for that. So Jack was given a mission from the CEO, the Chief Executive Officer, that he needed to come up with financing for $500 million in order to construct the company's new headquarters building. So here's the new Real Estate Empires headquarter building that Jack is going to be financing, and this building cost $500 million. So Jack's going to have to go out and try to find that money. So how does Jack finance a building of that size and to come up with that much money for his corporation? And like anything else, he would start at the bank. So Jack would go to the bank and he would sit down with personnel from the bank, and obviously he'd be meeting with some pretty high level people for a loan of that size. And what they'd do is they'd sit down and they'd look at all the things that we reviewed during Unit 1 when we were assessing the value of a stock. The bank would do a very similar thing where they'd be looking at the health of the company. That would be the first step that the bank would do to even see if they could lend that amount of money to a corporation like this. So let's say that after Jack had sat down with representatives of the bank and they determined that Jack's company was healthy enough in order to take on a loan of that size of $500 million, which is enormous. The bank decides that they're going to go ahead and facilitate that loan. How the bank is going to issue that money to Jack's business is they're going to do it through bonds. And so what I did is I just created kind of a generic bond here. And what the bank's going to do is they're going to make 500,000 bonds, and each bond has a par value of $1,000. And what the bank's going to do is they're going to take these slips of paper, these bonds, and they're going to sell these bonds to investors. And the money that the investors pay them through these bonds is going to be the same money that the bank hands over to Jack. So the bank creates 500,000 bonds, and each bond is $1,000. When you multiply those numbers together, you get the $500 million that Jack would be going after in order to build the headquarters building. So what the bank does is the bank comes up with a rough coupon rate, and let's just say that it's 5%. Based off of the risk and the interest rates that are all happening during the time when Jack would have gone to try to get the loan. And so based off of that, they're going to go ahead and issue a bond at 5%. So as Jack comes in, he's going to come back to the bank, and the bank's going to sit down, and the bank at this point hasn't issued any of the bonds yet, but they're still going to facilitate the loan. They're going to go ahead and give Jack's company the $500 million that they need in order to start financing and building the building that they need. After they do that, after they give Jack his $500 million, they're now sitting on those 500,000 bonds that they're going to distribute and start selling to investors. So let's go to the next step here. Okay, there's our investors. And so the bank, after Jack's out of the equation, Jack got his $500 million from the bank. And now the bank is going to go ahead and issue and start selling these 500,000 bonds to all sorts of investors. Now, one investor might buy 1,000 bonds. The next person might buy 100 bonds. But the bank is going to be selling each one of those bonds. And the bank, instead of charging $1,000, they might charge $1,005 for each bond sold. And that difference, that $5 difference, we'll call it, is what's called the underwriter's fee, and that's how the bank makes their money because they're selling off all these bonds. So because they're selling 500,000 bonds, and let's say they mark each bond up $5, that's how the bank's making their money. So the investors get their bond, and they pay $1,005 to get into that bond, and when they hold that slip of paper, what they're actually going to receive, you see how it says the coupon rate is 5%. And so they're going to receive 5% on their $1,000, okay, and the 5% goes off the par value, not the price that they paid for the bond. Okay, that's really important to take note. So they're going to make 5% a year on the $1,000. So every single year they're going to make $50. And bonds are typically paid 2 times a year. So these investors, if one of these investors had one bond, they'd receive $25 after 6 months of owning it, and then the next 6 months they'd get another $25. And they'd keep getting those $25 payments for the total term of the bond, which would be 30 years. And then, and this is also a very important part, at the very end of that 30 years, they'd receive their $1,000 par value investment back. And that would be paid by Jack's company. So Jack's company would also be making that coupon payment of that 5% each payment. So after the bank sells off that bond, the relationship at that point is now between Jack and the investors. So let me go ahead and recap this real fast so you can kind of see how the flow of money would occur during this transaction. So Jack needed the $500 million. The bank supplied him that $500 million. So there you can see the money going right towards Jack. After Jack received the $500 million, the bank now has 500,000 bonds that they now need to start selling to investors. Now, if they don't sell all the bonds initially off to the investors and the banks continue to hold the bonds, well, then the bank would receive their coupon payments, those 5% coupon payments. But if the bank does sell the bonds off to the investors, which they want to do because they ultimately don't want to be responsible for that size of a loan, they want to push that responsibility off onto the investors. But after the bank would go ahead and start selling those bonds off to the investors, and now the investors have all the bonds, the relationship is now between Jack and the investors. And so Jack's company is going to continue to make the 5% coupon payments to those investors, and they're going to make that every 6 months. They're going to make another payment. They're going to keep making those payments clear up to the 30 years. So those investors are getting paid 5% on that initial investment when they bought their bond for 30 years. And then after the 30 years, the bond becomes mature, and that's an important term to know. The bond becomes mature after the term limit, and Jack's company now has to pay all those investors, or whoever's holding the bond, whoever holds the bond after the term comes up, they all receive a $1,000 payment, the par value. They receive that $1,000 payment after the bond becomes mature. And that's it. That's really all there is to it. Okay, so who issues bonds? Okay, there's really just two divisions for this, and one is corporations and the other is government. So the model that I just walked you through was a corporation. If a corporation needed to raise money, that's one of the options that they have in order to raise those funds, is to go to a bank and have the bank issue bonds. So you understand that model, and when you're talking at the government level, they do the exact same thing. They go through the same steps. They'll go to the bank. The bank will look at the capability that the government actually has to repay the bond. So when you get into like the state and local level, they don't have the luxury of the federal level that they can just print more money, because they don't have state dollars or they don't have local dollars. They're using federal dollars. So the state and local government have to remain within their boundaries and watch their balance sheets and make sure that the revenues that they bring in aren't exceeding the expenses that they have. So when they go to the bank's going to do the same thing, and they're going to assess their ability, the local government or the state government's ability to repay the loan. And the interest rate that they would make the bond for would be corresponding to their ability to pay that off. When you get into the federal level, Warren Buffett considers this a zero risk investment simply because the federal government has the ability and the luxury to just print more money if they need to. Now, that causes inflation in the long run, but we'll talk about that later on as we get into some of the more advanced lessons in the second course on this website. But all you really need to know is, generally speaking, the federal government's bond is considered zero risk because they can just print more money in order to fulfill the coupon payments. So speaking about the risks associated with bonds, the thing you got to really think about are these three things. The first one is whether the company or the government would have a failure, because if that company, let's say we go back to Jack's company, although he might have got a really good interest rate because maybe whenever he went in for his initial screening, everything looked like the company had full ability to pay back their loans, but that's a long loan. That's 30 years long. So 15 years later, maybe you got new management, maybe you have a new board of directors, and the direction that the company has taken has become a whole lot riskier. And what you'll find is that company, the risk associated with the company, and maybe their inability to continue making their coupon payments, starts showing up in the market, and people start trading that bond much lower because there's no anticipation that the coupon payments are going to be sustained. The next risk that's associated with bonds is that when interest rates change, the bond value, the market value of that bond is also going to change. So let's assume that you just went out and you bought a 5% federal bond, and 2 years later interest rates went down to 4%. So here you are holding that 5% bond, and 2 years later the best people can get when they go out and want to buy a bond is 4%. So there's an enormous advantage that you have holding a bond that is paying a higher interest rate than what people can go out and get at 4%, and so the value of your bond on the market goes up significantly based off of that change. And the last thing that is a risk associated with a bond is inflation. If you would go out and you'd buy a 5% bond and inflation throughout the term of that bond is 4%, all the more money you're going to make, relatively speaking, is 1%. So when you're figuring out the value of a bond, you absolutely have to subtract out the inflation that occurs through that duration that you own the bond. And that's something very important to understand. And we'll talk about all those factors much more in the second course, but this is just a general overview. Okay, so I briefly talked about a company that would start performing poorly. And let's assume that you're holding a bond for a company that actually does fail and goes through bankruptcy. I know in 2008, 2009 timeframe, this was real for General Motors. They went through bankruptcy. And so when something like this happens, the order of distribution for the equity that remains in that company whenever they go bankrupt, the order of precedence is that the bondholders receive their money first, then the preferred shareholders, then the common shareholders. Now in the first unit, what we were talking about were common shares. So you'd be last in order there to receive distributions of what was remaining in the company if it would fail. So that's one of the things that is really great about bonds, is that your level of risk is a lot lower than dealing with common shares, because if something bad happens, you're the first person to receive payment if there's any money left. So that's something else you got to consider. And a lot of times when you're talking bankruptcy, there's not really too much left. So that's just something else to think about. So why would you invest in a bond? And a lot of people, they really don't see the value in it because they see maybe a low coupon rate of maybe 5%. But what I'm going to do is I'm going to show you why investing in bonds is absolutely just as important as investing in stocks. And this is so fundamental to Warren Buffett's investing approach, and this is something that I really want you to pay close attention to. So what I got here is the Dow Jones Industrial Average through our last market crash in 2008, and you can see the timeline above there. And what I did is I looked up what the 30-year federal bond rate was back in the beginning of 2007, and that bond rate was around 5%. And then what else I did, and if you've gone through the first unit, you understand what the price to earnings ratio is, and if you don't, I recommend that you go back and definitely watch that first unit before you jump here to the second unit, because this will make a whole lot more sense. But during that same time in 2007, at the beginning of 2007, the average price to earnings ratio on the Dow Jones was 27. So as you remember, if we take the reciprocal of our price to earnings ratio, that gives us a pretty generic and rough estimate of what our return will be. And so taking the reciprocal, which just means 1 divided by that price to earnings ratio, so it'd be 1 divided by 27, our return is 3.7%. So looking at the bond, a federal bond, which we've already established is almost a zero risk investment, and it's making 5%, and if you would go and invest in the Dow Jones Industrial Average and your PE is at 27 and you can only expect a 3.7% return, it's pretty obvious which investment here is the better choice. And that's that the bond is, because you'd be making 5% opposed to 3.7%. And so when you look at this chart, you can see how stocks were probably trading like wildfire back in 2007, and everyone and their kid was involved in the stock market. But yet the bond is where Warren Buffett and really smart value investors would have been, because they know that they're going to get a better return on it. And so what that does, and they weren't predicting anything. They're not predicting anything here. All they're doing is simply reacting to what's a better value. And at this point, it was the bond. Now, as we look over to the right side, let's go to 2009 and look at how the numbers changed. So now in 2009, a 30-year federal bond is now at 2.83% because the federal government's trying to stimulate the economy. They dropped the interest rates, okay? And now we look at the average price to earnings ratio for stocks, and it's a 15. So when we take the reciprocal of 15, which is 1 divided by 15, our return is 6.7%, almost double where it was 2 years earlier. So now let's look at that return. So bonds are now 2.83%, and stocks are at 6.7% on average across the board. Which one's the better investment? Well, of course, the stocks are the better investment. And of course, that's what Warren Buffett and all the billionaires were doing, was they were buying up all these stocks when they were at dirt cheap prices, and they were, minimizing, they were buying companies that had very little debt. And so what they knew is they were always on the right side of the equation. They were always investing in bonds when they should have been, and they were investing in stocks when they should have been, because they were simply making that comparison. And that is so vitally important to understand. So let's have some fun here. Let's assume that we bought a 30-year federal bond back in 2007 because we saw it was at 5%. And the price was $1,000 per bond. So let's just buy one bond for $1,000 back then. So then we hold on to that bond, okay, and now in 2009, the interest rates dropped down to 2.83%, okay? And when those interest rates drop and you're holding, because remember, we bought the 5% bond, so we're holding that 5% bond. And now it's 2 years later, and the best that anybody can go out and find is 2.83%. But what are you holding on to? You're holding on to the 5% bond. And who doesn't want to buy a 5% bond when interest rates are that low? So your bond becomes more valuable on the market because you're holding the 5% bond when everyone else can only get 2.83%. And so the value would have changed approximately up to $1,418. And then when you add in 2 years of coupon payments, that actually goes up to $518 that you would have made in a 2-year period. So that's about a 25% return for owning that bond in just 2 years. So that's why investing in bonds is so important, and just it's equally important to Warren Buffett's investing approaches as much as stocks. But unfortunately, a lot of people don't talk about that, and they really don't understand how he's doing that. But this is what he's doing. So why invest in bonds? And what I just said, understanding bonds is just as important as understanding stocks. And what you're going to find is that a lot of the times when the stocks are really high, the bond prices are really low and of great value, and vice versa. You're going to see the exact opposite whenever the bond prices, when interest rates are really low and no one's trading on the stocks, that's when you really want to be involved in the stocks. So that concludes the first lesson of Unit 2. We learned what is a bond, we learned who uses bonds, we learned about bond risk, and why is bond investing so lucrative. And I really hope that this, it might have moved a little too fast, but just kind of stay with things. I wanted to get everything out on the table so that you could kind of understand where I'm going with this. So I hope to see you in Lesson 2.